All right. So, Mr. Jeffrey Levine, he is the lead financial planning nerd for Kitsies.com. He's also the chief planning officer at Focus Partners Wealth. And in 2020, Jeff was named by investment advisors as one of the top 25 voices to turn to during uncertain times. Jeff is a past recipient of the Standing Ovation Award, presenting by the AICPA Financial Planning Division, and he was named to the 40 Under 40 by Investment News. So Jeff, if you want to come on screen, I can stop sharing and then we'll hand it off to you and you can kick it off.
Absolutely. Good morning, and thanks, Laura. And it's great to see everyone. I always love being here with my friends over at Holistiplan, and we're going to talk today about a really a topic of renewed importance, I think, given the current climate we're in. As you heard Laura mention, we will talk about what's coming down the road here with Roger a little bit at the end of my discussion. We're going to have like a little bonus time talking about what's coming. But, spoiler alert, one of the things that is likely to be here next year is the 20% pass-through deduction. And that's why, when we were talking about what's a good topic for us to do this session, we said, well, what's something that is really meaty that maybe advisors haven't paid as much attention to in the recent past. And in fact, this is one area where I've been out on the road and people have said, I'm not going to spend all that time diving in and learning this now because at the end of the day, it's going to go away in 2026. Well, it's probably not going to be going away in 26 anymore, right? In all likelihood, the 20% pass-through deduction, the QBI deduction, the qualified small business deduction, the 199A deduction, whatever you want to call it, right? That deduction that is for business profits is likely here to stick around for the foreseeable future. And so with that in mind, what I want to do with our next, 55 minutes or so is to make sure that when we leave here, everyone has a really sound understanding of one, how this thing is actually calculated. Now, is my goal for you to be able to turn around and, do tax returns with it? No. But I do want you to be able to, for instance, pull up Holistiplan and be able to model a scenario in there. And also to think about like what are the what are the sort of planning strategies that I can bring to bear on my client's situation to help them get more out of this deduction. Remember, this could be a 20% deduction on business profits. If you've got a high income client making a $500,000 a year from their business, that's a potential $100,000 a year deduction each and every year. So there is a lot of bang for the buck if you take the time to really go through this. And I'll share with you just at a high level, when I review returns of business owners, I would say, upwards of 3/4 of the returns that I look at, or I shouldn't say the returns, but the situations I look at, there are things that the business owner could do to be more effective with their tax planning to squeeze a little bit more out of this deduction. So we're going to talk first about how is this calculated, and the reason for that is simply different businesses have different strategies, but you have to understand how the basic framework of how the deduction is calculated in order to be able to understand which strategies you can bring to bear on your client's situation. So let's start from the beginning. First off, what businesses are eligible for this deduction? And simply put, it's pass-through businesses. So that includes sole proprietorships, it includes S corporations, or really businesses that are taxed as S corporations. There is no such thing as a quote unquote S corporation, right? Like we talk about that all the time, like, oh, I have an S corp. No, you don't. You either have a corporation or you have like an LLC, and you might have an S corporation election on it, but there's no way to go to your state and create an S corporation. You create an LLC, you create a corporation, and then a federal tax election is made. Now, partnerships also another one, and excuse me, and other pass-through entities, things like LLPs and whatnot. As a reminder, if you do have questions, technical questions, feel free to throw those into the the Q&A box, and periodically you'll see me, glance over here to the side. I've got a separate monitor up, and and I'll address those. So I do see one question here. It says, welcome, the Hammer. Are there any relevant updates from Secure Act 2.0 that came out last year? There are a ton of things related to that. And if we have time at the end, I will gladly turn to answer those questions. But for the sake of making sure that we get through our QBI deduction, I'm going to sort of try and lock it in here, if you will, on the QBI deduction stuff, at least for the time being. So as we move on here and we talk about our next topic, the QBI deduction is for, QBI stands for qualified business income. Again, I'm going to repeat that. It's qualified business income, right? With the emphasis on the word business. So why is that important? Well, because the word business is not actually well defined in the tax code. In fact, there are a bunch of different definitions out there. And when the regulations first came out years and years and years ago, the proposed regulations, you can see here on the screen, they've since been finalized. Everybody was sort of hoping, like, boy, please don't use the definition of 162. Please, IRS, choose anything other than that. And of course, the IRS chose Section 162 just to make our lives more difficult. And the reason why tax preparers everywhere did not want that was it's just not well defined. Section 162 basically says you got to be engaged in a business for profit. It has to be regular and continuous. And while in many instances it's pretty clear, right? Like, oh, yeah, that's a business. There are a lot of times where it can get a little bit murky. Real estate is one of the biggest ones here. For instance, rental real estate can certainly qualify as a business. Right now, we're not talking about like in the business of as a, like that's your regular job, but just the 162 definition. Are you engaged in this regularly, continuously, and for profit? Well, a lot of businesses qualify, or real estate businesses, but what if your client has like a triple net lease property, right? Just as an example of where this can get murky. What are they doing? Yeah, they're engaged for a profit, but what are they doing regularly and continuously, right? What are they doing on the regular that would make this a 162 business? Are they going to the bank once a month to cash the check? I mean, like a triple net lease, right? Everything is done. You're just cashing. And even today with technology, you may not even have to actually go to the bank to cash the check. So what are you doing? This is where, relying on your client's tax preparer or some other sort of tax professional, a tax attorney in some cases, can be important. Again, deciding whether or not the thing that your client does that generates income rises to the level of a business. Again, in most cases, pretty clear, but not all. All right, but we're going to assume for the rest of our discussion, your client has a business. The next question is, how much do they get as a QBI deduction? And at a very high level, we've got here a sense that the deduction is equal to the lesser of two things, either combined qualified business income or taxable income before the application of the deduction and less capital gains. So let's talk about each of these in a little bit greater detail, right? First off, combined qualified business income. I've got a slide here coming up that really illustrates that. But combined qualified business income is itself a combination, hence combined qualified business income, of two things: combined REIT and publicly traded partnership income and your client's actual business income. The second element here, taxable income before the application of the pass-through deduction, less capital gains. Effectively, what this is saying is taxable income, but you can't look at it after. It's like a circular calculation almost, right? Because true taxable income is looking at income and then already backing out your QBI deduction, because that's how you get to taxable income. You look at things after all of your deductions. But if you did that and then phased out, like you'd have this weird circular calculation going on there. So effectively, we need to look at what is your client's taxable income before we even apply the QBI deduction, and having already backed out capital gains. And here, that definition of capital gains includes qualified dividends. So basically, you need to look at your client's return and say, okay, how much in dividends and qualified dividends, how much in capital gains did they have? We'll subtract that from a taxable income amount, and that will be the income we use to determine this 20%. And that's it. And then effectively, it's 20% of the lesser of those two amounts. So again, let's talk a little bit more about this in graphic form. So here's a visualization of what it looks like to calculate combined QBI. Okay, this is what it looks like to calculate combined QBI. Effectively, on the left side of the screen here, what you see is a funnel where we put in publicly traded partnership income and qualified REIT dividends. And then what happens is we add those two up, and to the extent that they're positive, we're going to drop that amount down into our combined qualified business income piggy bank, if you will. Now, if it's a negative, then it goes to the side and it's held sort of in suspense to offset future years' positive REIT dividends and publicly traded partnership income. And while you can't really have negative REIT dividends, there's no way to like negative that. You can have negative publicly traded partnership income, right? Your client gets a K1 from the MLP they're invested in, and that is going to, that has a loss in box one. Well, that could more than offset their REIT dividends. That would be a net loss between the two of those, right? Added up their publicly traded partnership income, added up their qualified REIT dividends. It was a negative number. The negative number does not go down into the qualified business income piggy bank. Instead, again, it's sort of held off to the side to offset future years' positive income on that side. We only drop positive numbers into our combined qualified business income piggy bank. Now, on the other side of the screen, we've got your client's total qualified business income. We look at all their businesses, we add them up, we take the gains from the businesses that have gains, we offset them against the businesses that have losses, and we say at the end of the day, is that a positive number? If it's not, if it's a negative, if your client has a net loss from their businesses, that gets held to the side and will offset future years' business income that's positive. But if it is a positive, and hopefully it is for your client, then again, it goes down into our combined QBI piggy bank. At that point, we've got our combined qualified business income. It's the net positive from the left side, our positive publicly traded partnership income and REIT dividends, and the right side, our positive business income. Those two net positives combine to create qualified business income. Now, then the next step is simply to say, is the amount in that piggy bank more or less than 20% of that taxable income amount we talked about? So here's the next slide. I just switched it. And everything from the piggy bank up is exactly a photocopy, if you will, from the last slide. The only difference here is now I'm saying, okay, is that piggy bank more or less than 20% of the client's taxable income, again, with all those adjustments. If the combined qualified business income from the business is less, well, then that's the lesser of the two. We'll take 20% times that amount, and that will be the client's deduction. So that might be an example where you've got a client who works and makes $200,000 of business profits, but they're married to someone who has a $400,000 salary. Their taxable income will likely be much higher than their business income. By contrast, if that QBI, that combined qualified business income piggy bank, is higher than taxable income, take somebody who has a sole proprietorship. They make $150,000 a year, and that's their only source of income. Well, off of that, they're going to have things like maybe the standard deduction, and so their taxable income will be less than their business income. Well, if the taxable income is less, then 20% is the way the deduction is calculated there. And that's it. So I want to be really clear here. I already see questions about, hey, I've seen things about SSTBs or this and that. Like, what if a client is in this business? The simple way to calculate this deduction, and we'll talk about how it gets more complex, but that's it. We're done. It's 20% of the lesser of those two amounts. And for a lot of our clients, that's it. There's nothing else we need to do from a calculation perspective. It doesn't matter what business they're in. It doesn't matter how much in wages they pay or anything like that. For a lot of our clients, we are already done. So as complicated as this is made out to be, and it can get that way, for a lot of our clients, it's much more simplified than one would think. We've already got the number in our head. It's the 20% number times the lesser of our piggy bank of combined qualified business income, or if less, their taxable income. Now, as we think about where that deduction is taken, when this deduction was first created, a lot of people were calling it an in-between-the-line deduction. Because it's what's interesting is that it's a personal income tax deduction for business income. So it's a deduction taken on the 1040, right? Even though it's attributable to business profits, something that might come from a 1120S or a partnership return or even a Schedule C, right? No matter where it's coming from a business it's not taken on the business return. It's taken on an individual's personal return, and their personal unique tax attributes will, in many cases, determine how much, if any, of the deduction they get. In other words, two people with the exact same role in the business, with the exact same ownership in the business, with the exact same income coming from the business, can actually report two very different deduction amounts on their personal returns, because the amount that they report can be impacted by other elements on a personal return. As I mentioned, when the law first came out, a lot of people were calling it an in-between-the-line deduction. As it turns out, I think a better way to describe it is a below the line deduction, and you'll see why here in just a moment. But you might say, well, Jeff, what is that? Well, first off, I don't really care that you remember my silly name, a below the line deduction. But what I do care is that when you're done today, you remember that this is unique. It's a deduction that is in a class all by itself for a few reasons, and one of them is that it doesn't work like any other deduction. Every other deduction you can think of is either an above the line deduction, in which case we should know two things. One is you don't have to itemize, right? You can take the IRA deduction and take a standard deduction, right? That's fine. So you don't have to itemize to take the above the line deductions. And on top of that, they have the benefit of not only reducing taxable income, but they also reduce AGI. And remember, that's really important, because most things that phase out on a tax return that are good, that are, things like credits, deductions, et cetera, they're phased out based on AGI. And most things that are bad that start happening, things like surtaxes, Medicare Part B premiums, et cetera, those are things that are also keyed to AGI. So having a deduction that reduces income before AGI is more valuable than one that is reducing income after AGI, because it helps to take care of all of those things or mitigate those things. So we've got above the line deductions, again, no itemization required, and it reduces AGI. A QBI deduction, you don't have to itemize to take it. So that would lead you to say, well, it must be an above the line deduction because you don't have to itemize. But the Tax Cut and Jobs Act was explicitly clear. You cannot use a QBI deduction to reduce AGI. It happens afterwards. So it's, again, in a category by itself. It's the only deduction that you don't have to itemize for, but that comes off after AGI. It's a below the line deduction as it appears on a tax return. Here's a 1040 for, looks like I forgot to change the number at the top. This is 2024, not 2022. You can see the actual image there on the right side. But on this document, right, if we look at the lines, we have total income above it, adjusted gross income is above it. Then after we have adjusted gross income, we're taking the standard deduction or itemized deduction. So we've got AGI there. You can see that on, again, my blown up version here. AGI on line 11. On line 12, we're taking off your client's standard deduction or their itemized deduction, depending upon which they qualify for. And then after that happens, we're saying, by the way, there's one more deduction we didn't account for yet. It's the QBI deduction. Take that deduction now. So it's effectively a below the line deduction. Again, the key takeaway for you is that clients don't have to itemize to take it, but it does not reduce AGI. All right, so now let's move on to talk about the differences in businesses and how that impacts the calculation. I mentioned at a few moments ago that for a lot of our clients, we're done. We've already calculated the deduction. Nothing else matters. And that's true for any what we will call low income clients. Now, low income, what does low mean? Well, low is a relative term, right? Low compared to what? Right? For someone who makes $1 billion a year, $100 million, or someone who has a $1 billion, someone with $100 million doesn't have a lot of money, right? Someone with $100 million, someone with $1 million doesn't have a lot of money. Someone with $100,000, you get the point, right? It's all relative. So we got to define what we mean when we say low, high. Those aren't definitive numbers. Low here for qualified business income tax deduction purposes simply means income below the phase-out threshold, where it starts. And you can see here the numbers for both last year and this year. For married couples, we're talking about almost $400,000 of income. And not only that, what's unique as well about the QBI deduction, I told you it was unique for a few factors. One of them we just talked about, that below the line deduction element. But another one is, it is the only deduction that is phased out based on your client's taxable income. It's not an AGI-based threshold like everything else. It's based on taxable income. So in fact, clients this year might have $425,000 of taxable income if they are married and file a joint return. And then we take off their $30,000 standard deduction, and they're still right at the bottom. So you can have $425,000 of income as a married couple and still, for our purposes, for this deduction, be a quote-unquote low-income client. And the benefit of being low income here is that we don't have to worry about anything else. That calculation we already performed, 20% of the lesser of either combined qualified business income or taxable income, is the calculation for the deduction. We're done. I don't care what business you are. If you're a financial advisor, right? I've heard over the years, like, oh, it doesn't apply to me because I'm a financial. No, it does, unless you make more than this amount of income. But there are a lot of financial advisors that don't make more than $400,000 of income, and they still get a deduction. It does not matter. Okay? It also doesn't matter how much in wages you pay or how much in depreciable property your business owns. None of that matters. If you are a low-income client, with low being defined, as you see here, income below the thresholds, we were done on that other slide. That was it. Now, of course, if I'm making such a big deal out of this, you've got to understand, or you've got to suspect at least, that there's going to be a difference as we talk about some of the higher earning clients. And indeed there is, and one of the first things we need to do as clients have high income is now we have to start to understand, what sort of business does your client have? What do they do? Are they an SSTB or a non-SSTB? And here, those terms those are short for specified service, trade, or business, or non-specified service, trade, or business. And we've been conditioned since birth, right? Like red, bad, green, good. So that's going to be the case here, right? So first off, what on earth is a specified service, trade, or business? Simply put, it is a business as defined by the Congress as being in one of these categories. Things like health, law, accounting. And while I'm not going to go into the nuances of each and every one of these, what I will share with you is, for the most part, they are defined very broadly. For instance, I'll just use health as an example to make my point. If your client came to you and said, hey, I just had to spend $10,000 on surgery for my dog, how much is deductible on my tax return? Well, as much as we may love our dog, and as much as we may consider the dog a part of our family, the tax code does not. It is not a qualified medical expense. However, when we're talking about the fields of health here for this purpose, if your client's a veterinarian, they are going to be in the field of health. So again, this is very broadly defined. Now, here's the good news and the bad news for these individuals. The good news is that if you are a high-income individual and you are in one of these businesses, and I'm going to define high income as people who are not only not just not below their phase out, but people who have gone through their phase out range. So you saw the start of those phase outs on the previous slide. It was about $400,000 for joint filers this year, about $200,000 for single filers. For married couples, there's a $100,000 phase out range, so roughly $400,000 to $500,000. For single filers, roughly $200,000 to $250,000 is the phase out range. For high income clients of specified service businesses, It's the kiss of death. The good news is calculating the deduction for those individuals is really easy, really easy. The bad news is it's really easy because it is always $0, right? So it's not a good thing, right? If you are a high income individual and you're in a specified service business, so just going back one slide, you're a financial advisor or a doctor or a lawyer and you make $600,000 a year of taxable income. Well, you're above your phase out range. Your deduction is going to be 0. Period. End of story. And there's nothing I can do. I can't think about wages. I can't think about depreciable profit. None of it matters. If you're a specified service, trade, or business, your deduction is 0 if you're over your phase out range. So already, if you're thinking proactively, as hopefully you are, when we're working with a client who's a high income specified service, trade, or business, there may be a number of ways to think about accomplishing this, but at a global level, there's really only one way to increase their QBI deduction. What is it? Lower their income, right? Like there's nothing else you could do. If their income is high and above the phase out range, it's gone. So the only thing you could do is get it below the phase out range so they get some. Now, how about high income clients who are not a specified service business? I'm just going to use your client's a widget maker as an example here. Well, there it's more complicated. There, maybe they still get the full QBI deduction. In other words, it's 20% of their business income or their taxable income, whichever is less, right? That's possible. They might get no deduction in certain circumstances, or they might get a partial deduction. So here's the deal. The way we determine that is we look at some attributes of the business and we perform some tests. The way I have explained this for years, and it's a little bit of a corny analogy or example, but I've run across advisors afterwards who go, now I get it. So I'm going to use my sort of very silly example here, but hopefully it illustrates the point. When you have a client who has high income, I want you to imagine that they're on a ship and they're out to sea in the middle of the ocean, right? And as their income gets high and high and high, they fall overboard, right? And their deduction now begins to float away. If they are an individual who is the owner of a specified service business, I guess we could call the ship the SSTB, right? They would be out in the water and we're running around the boat looking for one of those life rings, right? To throw them and bring that deduction, to save the deduction. We want to save it. But you're running around your SSTB, your specified service, trade, or business, and there are no life rings. It's gone. There's nothing you can do. No way to save that person who's floating out. No way to save that deduction that's floating off into the wide open ocean. Now, by contrast, if you were on the same ship, but it was a non-specified service, trade, or business, you run around the ship looking for the same life raft. And lo and behold, you can find one. But the size of that ring, the size that the ability to reach out and save, pull back some of that deduction is determined based on either the wages of the business that are paid or the wages and the depreciable property of the business. Effectively, you can see here that second major bullet on the screen has 2 sub-bullet points. Those are the 2 tests. We either look at 50% of the wages the business pays or 25% of the wages paid plus 2.5% of the unadjusted basis of depreciable property. If you're wondering, what does that term mean, unadjusted basis of depreciable property? Well, if you buy a building, right? The first year you have the building, it might be worth $1 million, but over time you depreciate it. So 10 years in, your $1 million building might have a basis of, call it $700,000. For purposes of this test, you use the $1 million initial value of the business, okay? Then we just look and we say, which of those 2 things is higher? And then that is the size of the life ring that we can throw overboard. So if your client had a business that paid $200,000 in wages and they were a high income, non-specified service business owner, well, 50% of $200,000 is $100,000. That is the amount, the size of the life raft that I can throw overboard and bring back, save the QBI deduction that would otherwise float away. Now, is it big enough? Well, it depends. What was the original QBI deduction? If the business had a relatively nominal profit. Let's say the business had $50,000 of profit for the year. Well, that's a $10,000 QBI deduction. $100,000 more than covers that, right? So it depends upon where your client's profits are. If the business had, let's say, $2 million of profit, $2 million of profit times 20% is $400,000. But your life raft, if they paid $200,000 in wages, is only $100,000 large. You can only save $100,000 of the $400,000 deduction. So that's the way I think about it. And hopefully that's just a visualization of how that would work. And then again, just thinking about how you get to these numbers, if you want to know what the client's wages are, and look at the W-3, ask the CPA, things like that. And then the unadjusted basis of property, I've sort of already given you an analogy, or excuse me, an example there of how that works. Now, you noticed I said, like, let's talk about income below the phase-out range and then income above the phase-out range. I haven't really gotten into income within those phase-out ranges. I do have a slide here with a simplified calculation on how that works. Here you go. This is what it looks like when you're within the phase-out range. I'm only kidding here a little bit. It's much more complicated. It depends upon whether you're a specified service business or not. Effectively, the way your deduction phases out looks differently. But just know that if you're in the phase out range, you might get some, right? It's some. Whereas if you're below, you get it all. If you're above, it's going to depend upon the type of business you are. If you're in the middle of the phase out range, you'll get some. But the curve of how fast that deduction will go away from full before the QBI phase out to zero looks differently. They look very different for those two types of businesses, but it's still a phase out, right? One is exponential, one is more linear. That's all you have to know. All right, so now that's it. That's our discussion of how do we calculate this deduction? That's it. Now you're an expert. You know everything you need to know in terms of how to actually calculate the deduction. So now we're going to talk about how do we get more of this deduction for our clients. My goal is not that you remember every single element of every single strategy we're going to talk about right now, but rather what I want you to have is I want you to begin to build a Rolodex of solutions that if a client comes to you, go, oh, based on you and your business, your high income and your non-specified, here's the things that we can consider exploring. Right now, again, just as a summary, remember, low income, we're kind of good, right? We don't have to do the same level of planning. High income specified service business, the only way to get more deduction is to lower income. A high income non-specified service business, I have a couple of different levers I can pull. Either I can pull the lever of lowering income, just like a specified service business, so that it no longer matters, right? Like if it no longer matters that whether I have wages or business property because I'm below the income threshold, that's one way to get more potentially. The other way is I could look to manipulate my wages and depreciable property in a way that benefits the business owner. All right, so starting with our Rolodex of solutions, the first thing I want you to think about is there even a way or a potential benefit to separate the taxpayers? Normally speaking, most people file, if they're married, file joint because it saves them money on taxes and it's also easier. It's for the tax preparer, you're only filing one tax return, all of those things, right? However, when we're looking at the QBI deduction, and the quote there, you see there's different numbers. Those are the old phase-out numbers. We've changed over the last few years, but this is the copy of the tax code, if you will, as it was written. So what that shows you is that there's one number for joint filers and one phase-out for everyone else, including those who are married filing separate. So I want you to imagine a scenario where you have one spouse who makes, let's say, $200,000 a year as a sole proprietor, and they are let's say they're a sole proprietor CPA. A CPA would be under our accounting group for specified service business owners. So that would be a specified service business owner. Now, on their own, making $200,000 of business income, if they filed and took their standard deduction, they would get a QBI deduction because they would be a quote-unquote low income taxpayer by our definition. But what if that same individual was married to someone who had $400,000 of W-2 wages? Or maybe the couple had a significant amount of interest and dividends that they reported jointly, but that could be reported separately on another spouse's tax return, right? In those instances, you could consider filing separate returns. Now, sometimes this is a win. Sometimes it's not, but it's worth exploring. And what I share with advisors is, a lot of times we just think like, well, the CPA is going to take care of this when they file the tax return. They'll let them know if they should file separate. No, honestly, that's probably not going to happen. In the height of tax season, very few CPAs are going to go, you know what? The income that you have here sort of perfectly aligns to this other strategy that's going to require me to file an extra tax. It just doesn't happen, right? It's just too much going on. This is the type of projections or planning that need to be done outside generally of tax season so that when you get into it, you know what you're going to actually be doing. What you're looking for this is a high income specified service business owner client who has income as high as possible, but not so high as to phase themselves out, right? If that same CPA made $400,000 a year from their practice, well, their own income phases them out, and it doesn't matter if you file separate. So you want as high as possible so that you can get the biggest QBI deduction possible, but not so high as to phase yourself out. And then you need the other spouse with income that is high enough to phase out the other spouse's QBI deduction, but not so high on their own that it's not worth filing separate, that their income is so high that it loses all benefits. So it is, in fairness, like you're looking for the Goldilocks situation, right? Income not too big, not too small, but where it's there, it's worth exploring. Another thing we could do is we could look at moving people from salaried employees to independent contractors. Now, again, not every client is going to be able to do this, but think about it this way. If you're an employee, your wages are not eligible for the QBI deduction. If you are a sole proprietor, it's your business. You might be eligible for that. Maybe you have a client who works part-time for a business owner, or who has a full-time job but just says, hey, you know what? I would like to go to this business owner and propose a change in the way that we do business with one another. Instead of being your in-house marketer as a salaried employee, I want to become an independent contractor and I will perform services to your business. And by the way, in the right situation, you can find a win-win for the business owner and for the employee. Because maybe the business owner doesn't care. Maybe they're happy to pay, instead of $100,000 in wages and $20,000 of health insurance benefits and $10,000 of employment taxes, that's $130,000. Maybe they're happy to pay $120,000 or $125,000 for the same services. And now your client, yes, they have to pick up some of those expenses, but they may get a $20,000 deduction each year for their business profits. So it can be a win-win. We can go from a client who is an employee to a sole proprietor. We could actually go it the other way, right? We could look to say, we want to take outside labor and bring it into the business. And this is, again, these are types of things, now that we have a good sense that the QBI deduction will stick around for the foreseeable future, we should begin to investigate much more seriously. I understand why maybe last year or even the year before that, business owners were loath to implement changes that might have long-lasting repercussions, but for only a year or two worth of tax benefit. But now it looks like this is going to be around for the foreseeable future. What if we look to bring more people inside the business as employees? And here, your client situation is a high-income, non-specified service business owner. So think back. High income, all right, they're phasing out. Their deduction is floating out to sea, but they're not a specified service business owner. So I can run around my ship looking for that life raft, right? And I can find it and throw it overboard and save that deduction and bring it back. And that can include wages. So I'm going to share with you an example that is not, the numbers aren't exact, but this is a very similar situation to a real life scenario I had with a client years ago, right after the QBI deduction came out. And we were able to change the way they structured their business so as to get them a six-figure deduction each and every year, where otherwise they would have had none. And again, I've changed the numbers in the business, but this is effectively what happened. So the business owner had $600,000 of net profits and selling widgets. So they're a high income, they're above the phase-out range, but non-specified service business owner. Now on $600,000 of income, 20% times $600,000 of business profits, that's $120,000. That's their sort of maximum potential QBI deduction, right? That's their ceiling. And this particular business owner had a bunch of ICs, independent contractors, working for them, and they paid about $325,000 a year to those individuals. They had no wages paid and no depreciable property. Now, if that's the case, we're high income, deduction floats out, we run around the ship, we look, and even though it's a non-specified service business, there's no life raft, there's no wages paid, there's no depreciable property. We don't have anything. So what could we do? Well, one is we could lower their business income, but we don't want to lower their profits, right? And maybe they don't want to do a retirement plan, or maybe they already have one in place and there's just no more room. But what if we looked at the other side? What if we look to take that outside labor to say, no more independent contractors. Look, either you come work for us as an employee, or or we're going to find someone else to do that. Well, that is what happened. And let's just imagine that after paying wages of $255,000 of salary, plus health insurance, plus the employment taxes like Social Security and FICA, let's imagine that we got back to the same $600,000 of profit. Well, now my potential QBI deduction is still $120,000, right? That hasn't changed. Still 20% times $600,000. But now I've got $255,000 of wages that are paid. Half of $255,000 is $127,500. When I'm looking around my ship, I've got a life raft that can support $127,500. I throw it overboard, and lo and behold, it's big enough to bring back the entire deduction, because $120,000 is less than 50% of the wages paid. Imagine getting a $120,000 deduction every year when you might have gotten none. So that can be super valuable as well. I'll move through the next slide a little bit quicker, but just actually not this one. This one we'll pause on for a moment. Is there an opportunity here to take non-salary paying entities and move them to salary paying entities? Like, for instance, take a sole proprietorship or even a partnership and make it a corporation, an S corporation, so that you can pay yourself a salary. Because in the last example we looked at, right, it was great. We saved the deduction by hiring those people as employees instead of having them work for us as independent contractors. That was great. But if I was that business owner and I didn't already spend money on those people, like I didn't need that labor, I'm not going to go out and spend $300,000 on hiring new people so that I can get a deduction for $120,000, right? Like, that doesn't make sense. To spend $300,000 to get a deduction for $120,000 that might save me $60,000 or so on taxes, that seems very silly. But what if I have a business that I could pay myself, but I don't? Here's an example: a sole proprietor who has $750,000 of net profits. You might say, well, shouldn't they have an S corp? Well, maybe they just never wanted to bother with it. They just wanted things to be simple. Well, 20% of $750,000 is $150,000 of potential QBI deduction. That's pretty big, right? But no wages, no depreciable property paid. There's no QBI deduction. So what could we do? Well, we could change the business into an S corporation. And let's just say we paid our owners $300,000 of salary. I'm ignoring employment taxes or things like that here. Let's just say we got back to the same then. We got back to $450,000 of net profit. Well, if I had $450,000 of net profit, $90,000 is 20% times $450. I've got a $90,000 potential QBI deduction here. And if the business owner paid themselves $300,000, well, 50% of that is 150. It's more than enough to cover my $90,000 potential QBI deduction, right? Well, here's the deal. Some of you are probably going, hey, that's great. We just got a $90,000 deduction. There are probably others on the call with us today who are going, well, that's great, but Jeff, you actually overdid it, right? You kind of paid them too much because you paid so much in salary that their profit was lower and they ended up with more salary than they needed. Like, couldn't you have like paid a little bit less in salary to have a little bit more profit, but still enough salary to? And the answer is yes, you could. And you could sort of guess and check your way to like an ideal salary, if you will, an ideal target salary. Or I could just have another slide that has a number for you to multiply by. And it's 28.57142 and change. You take the profits of the business before the owner's salary, multiply it by that number, which happens to equal 2/7. That's where that comes from. And the result is the perfect salary for QBI deduction purposes. So kind of going back here to our numbers, $750,000. Let's multiply that by 28.57. That gets us a salary of $214,000. It leaves us with $535,000 and change of net profit. 20% of that is $107,000 and change. There's a couple dollars difference here because I rounded, and that's it, right? They equal. Now I have a QBI deduction that is perfectly saved. The size of the deduction floating out to sea and my life raft are exactly the same because I use that 28.57% number. Now, in fairness here, right, like it is fair to say that if you are asked by the IRS under audit, and I know you all are not representing clients on audit, at least most of you, but you might, you work with clients, you certainly don't want them to be in that situation. If a client turned to the auditor and the auditor said, please explain to me how you arrived at your salary. How do you determine that this is a reasonable salary? And the client looked and said, oh, well, it was 28.57 of my business profit, so it gave me the highest QBI deduction. That is not going to fly with the IRS agent, right? S corporation salaries are a hot button issue. They have to be reasonable. But when I say this is the perfect salary, I mean, you got to know what you're aiming for in the first place, right? In this example, we'd aim for $214,000 to be a reasonable salary for the client. And then you begin to construct your narrative, right? If that's less than you think the client would make as a reasonable salary, you start to make arguments for that. Like, well, they don't work 40 hours a week anymore. They've got a lot of other people. If it's higher, you say, well, my client has a master's and they have years of experience. Like, there are all these things that we do to craft the narrative. Reasonable is not a number, right? Like, it's a very gray area with some number being like, yep, that is definitely reasonable. And as we go out and we expand, things become maybe a little bit less and less and less reasonable. But if you don't know what your target is, we never know what we're trying to craft as a narrative to begin with. All right, in some cases, it may change actually to go from an S corporation to an LLC, particularly if income is relatively close. If you think like, well, my client, they've got to have $150,000 of wages for a reasonable salary, and there's only $170,000 of profit in the business, you probably actually want to go away from the S Corp and go back to a partnership or a sole proprietorship, because in the S corporation, only the profits are eligible. Whereas with a partnership or a sole proprietorship, all of that income, other than guaranteed payments in a partnership, would be eligible for the same deduction. All right, I'm going to move us forward to retirement plans here. And I want to share the next 4 or 5 slides, I think, are some of the most impactful for advisors. Because when we think about our day-to-day work of what we do with clients, we work a lot with business owners looking at retirement planning, et cetera. Again, if you've paid attention to nothing else over the last hour or so, the next 4 or 5 slides will give you some key takeaways to think about with clients to help them make good choices. We've always said to clients, look at retirement planning, implement a retirement plan for your business that will help you achieve your long-term goals, et cetera. But I don't think clients really get how impactful that can be, especially if they are higher income where they're beginning to see some phase out of their QBI deduction. Now, I'm going to ask you a question. Obviously, you can't all answer me, but like, what's the highest tax rate right now? Now, your answer is, the chances are you're saying something like 37%. At least that's the answer most people will give. That is the highest tax bracket right now. It's not the highest tax rate. In fact, the QBI deduction, some people are familiar with the Social Security tax torpedo. There is a somewhat analogous effect with individuals as they go through a QBI deduction phase-out range where they can have a heightened or an accelerated marginal tax rate. And this year, that marginal tax rate can equal almost 51% federally alone. I'm going to give you an example to illustrate what I'm talking about here. So let's imagine your client has $524,600 of income. Now, that's a very specific number because I'm going to create a Goldilocks example for you. After taking a $30,000 standard deduction, they would have $494,600 of taxable income, right, before any QBI deduction. Well, that is exactly the top of their phase-out range. That is the last dollar that they had phased out the last dollar of their QBI deduction. Take my word for it, this year, that would result in a tax bill of about $112,000, okay? Just take my word for it. I've done the calculation for you. Absent any self-employment taxes, just ordinary income tax, that's a $112,000 tax bill on roughly $495,000 of taxable income. But now, let's imagine that I had the same client, and I started with the same $525,000 roughly. I took my same $30,000 standard deduction, but I somehow also lowered income by another $100,000. Call it a 401k that I make contributions for the owner and their spouse, or a defined benefit plan that I put in, or maybe even a giant charitable contribution to a donor advised fund. It really doesn't matter here. I'm lowering taxable income before the QBI deduction by $100,000. If I do that, now that income amount is $394,600, which is the very bottom of the phase-out range, which means it no longer matters whether I am a specified service business, a non-specified service business. Doesn't matter what wages or depreciable property my business has or pays. None of that matters. I get 20% times that amount. That is $78,920, or another $79,000 deduction in addition to the $100,000 deduction I already got. In other words, for every $1 I actually do something to get a deduction for, I'm going to get a bonus 80 cents in that phase-out range. The net result here is, after taking the $100,000 deduction for whatever I do, again, retirement contribution, charitable contribution, etc., and I factor in the increase in the QBI deduction I get, there's a net difference in, or a net tax bill of $61,457. Go back one slide, $112,000 of taxable income, of taxes before. I put $100,000 into a retirement plan or something like that, and now I'm down to $61,500 roughly. That is a $50,000 plus lowering of that federal income tax bill on $100,000 of income. Or go the other way. Think about it this way. As your client's income rises through that phase-out range, it's going to cost them another $50,000 plus in federal taxes. Add in state taxes, and it can be close to 60% in some areas. In some situations, the best advice to a client is, hey, take it easy. Don't work so darn hard. You could work 20% less over the course of the year, and your difference in take home would be like $40,000. Like, at some point, the client goes, okay, I'm working to make the next $100,000 so that 60 of it could go to taxes? That doesn't make any sense, right? Sometimes it's just, take it easy, Mr. and Mrs. Smith. Now, we think about the next element of retirement plans. This is something that I uncovered shortly after this deduction was put out there, and I coined this issue the so-called deduction reduction problem. And effectively what this is a scenario where clients may only be getting a deduction for a portion of their retirement contributions. The text you see here is right from the regulations, but what it means is, and you don't have to read all of this, but effectively, think of it this way. Whatever deductions a person has that are attributable to the business, they will lower that profit of the business that can be used for QBI deduction purposes, even if it's not actually on the business's income tax return. And so a good example of this would be, let's say your client is a partner in a partnership. The partnership kicks off their income. Your client will take their retirement deduction for a self-employed retirement plan on their 1040. But even if you do that, you still have to factor in that reduction in their net business profits. And effectively, this can lead to an 80% deduction for retirement contributions. I'm going to give you an example. I'll use an S corporation because it's a little bit easier to illustrate. But the same principle applies with sole proprietorships and also applies with partnerships. I want you to imagine that your client, Robin, owned 100% of the Woods Inc., an S corporation. And they paid themselves an $80,000 salary, and they had $90,000 of profit before their retirement plan contribution. All right? $80,000 was what the CPA said they've got to pay themselves to be reasonable salary. So the client did that. Now, what's the maximum, SEP contribution here? Or excuse me, I should say, what's the QBI deduction here? Well, before we do anything, it's $18,000, right? Like that is the potential deduction on $90,000 of profits. 20% times the profit, $18,000. But now let's suppose that Robin makes a QBI deduction, a SEP IRA contribution, which Robin does each and every year. The max deduction there is 25% times wages paid. Robin paid, Robin received $80,000 of wages. 25% of that is $20,000. That would be the SEP contribution deduction. But now if I make the SEP contribution, my profit is not $90,000, it's $70,000. And the QBI deduction on $70,000 of profit isn't $18,000, it's $14,000. So effectively, before I made the SEP contribution, I had $18,000 of net deductions between my QBI deduction and my SEP deduction. After I put $20,000 in, I have $34,000 of deductions. So effectively, after making $20,000 of SEP contributions, I increased my deductions by $16,000. Now, what happens if the very next day I change my mind and I take a $20,000 distribution from my SEP IRA? Am I taxed on the $16,000 and I've got $4,000 of non-deductible? No, because as far as the IRS is concerned, you got a $20,000 deduction for your SEP. You just lowered your QBI deduction. But I say, who cares? At the end of the day, I put $20,000 into something and I only got a $16,000 deduction. So what can you do in these situations? Well, first off, I've got a chart for you here. In order for that to make sense, your client has to be in a substantially higher tax rate now than they would be later on. Like that difference between current and future tax rate has to be magnified. Otherwise, it doesn't make sense. And you should consider things like maybe doing a solo 401k if possible. And instead of doing deductible contributions from the business, maybe do like the mega backdoor Roth and have more of the money going into the plan coming from the employee side, because the employee side doesn't reduce the profits of the business, right? Like your client can make their $20,000 or so salary deferral and then maybe put another 50 or so in as a non-deductible contribution from their salary, and everything else can be profit of the business. This way they maximize their QBI deduction. Now, it could actually go the other way too. In some cases, you might actually need to generate income. This is kind of the opposite of deduction reduction, something I call deduction production. In this particular instance, you're looking for clients who have taxable income that is lower than their business profit. Taxable income that's lower than their business profit. So an example here, let's say your client has $150,000 of profit from a CPA sole proprietorship that they operate. Well, 20% times 150 is $30,000, right? That would be their potential deduction. But let's say they didn't have any other income. And let's say they took a $30,000 standard deduction for them and their spouse. That means their taxable income is $120,000, right? So $120,000 is their taxable income. Their business income is $150,000. Remember, we take 20% on the lesser of those two. So in our example here, it would be 20% times $120,000. Now, if I had $150,000 of taxable income, I could actually increase my QBI deduction because here I'm limited by taxable income. Well, what if I did a $30,000 Roth conversion to take my $120,000 of income, taxable income, and raise it up to my business income? Well, now for every dollar I convert, I'm actually getting a little bit more QBI deduction. So in this example, right, for every dollar we would convert, we'd actually only pay tax on 80 cents. It's the opposite of deduction reduction. It's a wonderful way to help clients pay less for a Roth conversion. And it's really easy to spot. I know this is a lot of stuff and this can get really in the weeds, but here you just got to look at two numbers on the tax return. Look at their business profit and see, is that more than the number on the taxable income line? If the answer is yes, this is something to look at. It's a very simple if this then that sort of thought process. All right, and then finally here as we wrap up, and then I'll take maybe a couple of questions super quick, is think about bunching charitable deductions. Again, there is no difference in the example I gave you before of that client, whether they put $100,000 into a retirement plan like a pension plan, or they had made a $100,000 contribution to a donor advised fund. Lowering the income by $100,000 would have saved them $60,000 in taxes. Mr. and Mrs. Smith, do you want to give $100,000 to charity but really only spend 40 and have the other 60 come from the IRS? Well, here's how to do it, right? Things like that. We could look at changing partnership payments. Be mindful of guaranteed partnership payments. I have an example here for you about how you might shift a partnership from guaranteed payments to something that is functions without them, because again, guaranteed payments are not eligible for this deduction. So there's an example here for you. Obviously, you got to look at more than just taxes. Be aware of what that does to the partnership agreement, etc. We could look at transferring business into trusts for each beneficiary. Each trust could get its own little bit of QBI exemption. Remember that phase-out range is separate for every taxpayer, including a trust or an estate. So if your client has, let's say, 5 grandkids, they could create, or 5 children, they could create a trust for each of those kids. And even if the kids are above the phase-out range, they could fund a trust with just enough of their business interest so that the income that came out to the trust would be low enough that the trust would qualify for the deduction. And then after the trust gets the deduction, it can pass it on to the children after the trust pays taxes. There's lots of other things like that in the works here. And little things, even like shifting income from a business owner to a child. Put a child on the payroll if you can justify it. Pay them. This year you can pay a child up to $15,000 and they won't have any income taxes because it's earned income. Again, you have to justify it, but think about that. That can be $15,000 of tax-free income to the child, way better than allowance, and it can help reduce the business owner's income to maybe get below the phase-out. I mean, it could be a win-win-win. Look at portfolio income. Are there ways to minimize that so that we're not having income? I mean, there's all things to look at on an ongoing basis. But at the end of the day, the key point here is to remember what are the key things for my client that I need to look at in order to determine whether or not there are strategies I can bring to bear. At a high level, it's this. If they're low income, we're good. If they're high income, specified service business, you have one thing you can do: lower income. How you choose to do that: retirement contributions, charitable contributions, more depreciation, whatever it is, that's your choice. But you got to lower income. It's the only way to get more. For higher income individuals, we can start by looking at the same salary reducing methods, but also at the same time looking at ways to manipulate wages and depreciable property. Can I hire, independent contractors? Can I hire myself? Can I adjust wages to make this work? Those are the sorts of things you can do. And again, I think just about everything I shared with you today can be modeled within the Holistiplan system. So you can really do some great high-level projections for clients and show them the value that you can bring. This is one of those more nuanced and challenging areas for advisors for obvious reasons. It is complicated, but again, the rewards, in my opinion, are worth it. 20% of a potentially big number is a big number, and it can be a big number year after year after year. Think about that example I shared with you where we got a 6-figure deduction each year from nowhere. That is someone who will never, ever, ever leave. It doesn't matter what investment performance looks like. All right. I know there were a bunch of questions. I tried to answer most of them as we went through, and without actually calling out the question. I've been scrolling through here, but I will answer one more here. How do you split itemized deductions of a married couple that file separately? In that particular instance, first off, it's going to depend upon whether you're community property state or not, because community property states, as many of you know, you're going to have to apportion income between the spouses no matter what. There's not much you can do. For itemized deductions, you look at it by person, who paid what, and if certain things are shared, then you split them jointly. And then here we have, so if you're paying yourself a reasonable compensation, how does this change QBI, or does it? Paying yourself a reasonable compensation helps when you're a high-income, non-specified service business owner, or potentially does, because you can go from having no salary and no wages to use for your wage test to having wages. So it may not change your profit, right? You may just change things from one, or at the end of the day, what you're looking is to take what is $0 of QBI deduction and make it something, right? And there's the challenge here, and I'll close with this, and then Roger and I can talk about what's going to happen the rest of this year, probably. And it's simply this, right? There's no simple way to say everyone in this situation always does this, everyone in this situation always does that, because I shared with you an example, not too long ago, of where making a big retirement contribution might be bad because you might only get a deduction for 80 cents of the dollar. Well, that's not good. But what if you're above the phase-out range and you're getting nothing? Well, then getting 80 cents of the dollar is not so bad, right? So it really is a client-specific situation. It's why we can't just dive into the strategies. We have to go through the calculation first, because ultimately you need to understand how your specific client's deduction is going to be calculated so that you can figure out which of those strategies in the Rolodex of solutions we talked about might make sense for them. All right, Roger, let's, sorry, Laura. I see
Hey,
Laura
Jeff.
coming back on, and Roger. Everybody's here. All my friends are here.
No, that was great. Thank you so much, Jeff. That was awesome. That was awesome. So this next topic is going to be between Jeff and Roger, and it's going to be about 2025 policy updates. And I just wanted to do a quick intro. So Roger Pine is our CEO and the co-founder of Holistiplan. He was a financial advisor for 10 years, and he really is the brains behind the entire software. So I'll leave it up to you two.
Sounds good. Thanks, Laura. Jeff, this was a last-minute addition. I appreciate you offering to do this with a little bit of urging from our side, because it's 2025. The election happened, and
wait, there was an election?
Yeah, it was in the news a little bit. Yeah, and I tell you what, I have such a weird, as someone who has to sit there and code this stuff into software.
Mm-hmm.
It's hard for me to think of this stuff from a policy perspective. It's purely what's going to change and how bad is my life going to be recoding it all, which is a weird way to look at this, because I know the implications are enormous for a lot of people, and there's opinions and all that stuff. And we're not going to get into the good and bad of the policy. It's more just from the perspective of financial advisors, what do the tea leaves show us at the moment about what may or may not happen? Because we are starting to get some indications. Timing wise would be really interesting to hear too. Please tell me I'm not writing this code Christmas Eve or New Year's Eve at the end of the year. You remember that one year when they put in the patch after December 31st? What year was that?
Every year. That's every year.
Well, there was one. It was before but it was before Holistiplan, so I didn't have to code that. But like we have had.
Yeah, that was 2012. The American Taxpayer
Yes.
Relief Act of 2012 was
Yes.
passed on January 2nd, 2013.
Exactly. And then we did have one during COVID where in March there was some retroactive stuff that happened.
Yep.
And so that one we did have to code. Anyway, what are your thoughts? So like state of play, where are we as far as, of course, Tax Cuts and Jobs Act is meant to expire at the end of this year.
Yep.
What do you see happening between now and the end of the year to either extend that? What's going to change? How would you like to set this up?
Yeah, I mean, that's like 17 questions there. So
Yes,
let's go one by one.
It is.
All right. So the first one I would say is like we're going to get a tax bill, right? And in all likelihood, this is going to happen, I believe, relatively quickly. Roger, I don't like to guarantee anything when it comes to Washington because it is a weird place. But I would be shocked if you and I are sitting here at the last moments of the holiday season, fumbling through legislation. I think we'll probably get things done sometime in the first half of this year, potentially even before the end of the first quarter, though. I think probably first half is still a good target right now. I would say if I were
before the
betting
summer
man,
recess, yeah.
Yeah, if I was a betting man, I'd say May or June is when we see this. But it wouldn't surprise me to happen sooner. Look, here's the deal. At the end of the day, and you sort of set this up nicely, Roger. Like, we're not talking about good or bad or whatnot. Everybody's got different opinions on policy. But if we're being objective as advisors, whether you're happy with the results politically or you hate the results politically, our lives could not be any easier than they are right now. Right? Like, this was, from an advisor perspective, the absolute best case scenario from a will my life be a living you know what throughout the rest of this year. Because we do have a single party in control. And the single party that happens to be in control is the party that wrote the law that exists right now. So in all likelihood, we're going to see wholesale extensions of the Tax Cut and Jobs Act, right? Like, that is going to happen here at some point at the beginning of this year. Now, will be probably some changes. We'll talk about that in a second. But the key point here is, Republicans have the White House, they have the House of Representatives, and they have a simple majority in the Senate, which allows them to pass reconciliation bills. Unlike just about everything else, we don't need 60 votes in the Senate to actually get this done. So we're probably not going to see anything big on gun control in the next 4 years or 2 years because you're not going to get, enough Democrats to get to 60 in the Senate to get to cloture. You're not going to get to a vote. But you can do it with fiscal-related bills, and that's where we saw 2010's Affordable Care Act. It's where we saw 2017's Tax Cut and Jobs Act. It's where we saw the Inflation Reduction Act. The big tax policy legislation is almost always done by one party whenever they're in power. This is just a Republican's turn. And again, they're going to use that to keep the things that are in place today. Had Democrats won, right, we probably would have had a tax bill sometime, before the very end of the year, because they would have gotten together, just like I think Republicans will do, and they would have passed something under reconciliation. So it wouldn't have been a scenario where we were in next year before we had the rules, but the rules that would have been in place would have been a lot different than what exists now, right? Like, Roger, you would have been coding for a very, very, very long time, because there just would have been a lot more changes. Now, if there had been a split, our lives would have been miserable because there were a lot of people projecting that if there had been some shared control, any way of shared control, Democrats had won just one of the presidency, the House or the Senate, that we would have been in a scenario where it would have been super late in the year this year or potentially even well into 2026 before they would have settled on tax policy for 2026, which would have been a nightmare for advisors. That law you referenced, Roger, the one that changed at the beginning of the next year, a lot of people may not recall, but that was also going to be a big estate tax change. We were going from a $5 million exemption back down to a $1 million exemption. And so, there were wealthy people at the end of the year with advisors who had no idea what to do. They're like, well, it looks like Congress might do this, but they haven't done it yet. It could be 1 million. Do you really want to risk losing 4? And so people gave away a lot of money right at the end of the year. And then on January 2nd, the following year, the IRS said, nope, or Congress said, nope, don't worry about it. Everybody can still have a $5 million exemption. And then a lot of those really rich people spent a lot of their own money trying to undo the gifts that they just did. They try to say, nope, I was just kidding. Wasn't really a gift. They called it rescission, right? It was a fancy word for a take back, right? An undo button for a gift. And some of it worked, some of it didn't, but it was a nightmare for planners. We're not going to have to deal with that. We're going to get something early this year. Now, I say first half of the year because there's still some things to be worked out. You asked, what's likely to change, what's likely to stay the same. Look, I better say the QBI deduction is going to be around after the last hour we spent together, right? So
Sure.
QBI deduction is likely going to be here. The tax brackets will likely look, if not identical, pretty darn near identical. The standard deduction would stay. We're going to probably still not have to deal with miscellaneous itemized deductions.
Right.
The
Fees limitation not
the
happening,
estate tax
exemptions not coming back.
Say that again?
Sorry, personal exemptions not coming back.
Personal
Fees
exemption still
limitation
gone.
on
Estate tax
itemized
exemption still doubled. Like all of the child tax credit will be more than 1,000. Right now it's 2,000. There's talks about potentially raising that even further. But that's the stuff that is still very unclear at this point, right? Is the things that there's support in the Republican Party, either in mass or by some powerful group of individuals, or in the case of the president, one individual, right? Like Donald Trump has repeatedly said, President Trump has said, he wants tax tips and Social Security and overtime to be tax-free. Those are all expensive provisions, right? Those are all now, the good news is if any of those happen, it might change our projections. It probably doesn't change a whole lot of planning, if you will. Right, maybe some Roth conversion planning if Social Security is made tax-free or things like that, but it's not like we've got to rush to do anything. But those are things that all cost money. The SALT cap, that is probably the area of the biggest contention because there's intra-party fighting. You've got some Republicans saying, I have to see this raised. I live in a largely blue state, but I'm in a red pocket. And if you don't raise the SALT cap, I'm going to get run out. I'm not going to get reelected, which is actually what happened after the Tax Cut and Jobs Act, right? There was a flip in Congress after that happened, right? Republicans only had 2 years of control totally last time. We are likely to see an increase. Now, is that a doubling? Is it raise it to 50 for single filers and 100,000 for joint filers? I don't know. They're still fighting about that because on the other side, you've got deficit hawks on the Republican Party who say, we are going to explode the debt even more than it is, and we shouldn't be doing that. And so right now, it's just about coming to terms within their own party. But the president has a lot of political power at this point. He is a driving force in what the Republican Party does. And if people don't kind of get on, it's very clear. Like he has a lot of political capital. He's not afraid to use it at this point. And so I do think you're going to see a lot of the things that he wants either enacted or, there's going to be some element of it. And we are likely to see those sorts of changes. One last one will be the child tax credit. You heard Vice President Vance, J.D. Vance on the trail say he wants a $5,000 credit, per eligible child. Well, that's great, but that is also a really, really expensive provision. I'm not saying it shouldn't be there, but objectively, it costs a lot of money. The question is going to be, how quickly do Republican deficit hawks and Republicans on the SALT side and on the, hey, let's make Social Security tax-free side and all that sort of stuff, how quickly can they meet in the middle? The quicker they do that, the quicker we will have a tax bill, and we will be on our next webinar all together discussing it. And Roger, you and I will probably have many a nights together, pinging back and forth on Slack going, is this how this formula works? Nope, actually, no, it's like this. And it'll be all coded into Holistiplan by the time people wake up.
Perfect. Two things. You said it real quick, but I want to make sure we highlight this. In your view, estate tax likely to stay with a higher limits? Do you see that coming down at all?
I don't think there's any chance that goes
around
down.
that. Yeah. Okay.
Yeah.
I always say there's a lot of millionaires in Congress, and a lot of their donors are millionaires, and but
and they just don't like the party in power just does not like the estate tax. I think getting rid of it altogether is too politically untenable. People will just say, "Ah, you gave it. See, look, we told you were giving everything away to the millionaires and billionaires of the world." But keeping it high, I think that's if it was any lower, I would say I'd eat my hat, but I have no hat here. So
There we go. I see stuff about the carried interest provision,
yep.
which I'll admit I don't understand. Is that something that advisors need to worry about, or is that so niche that don't worry about it? Because I know
Yeah,
that
I
was
mean,
one
if
of the
you're
things that they wanted to actually crack down on that in the
that's right.
proposals that the White House brought to Congress.
Yeah, it's ironic that the two provisions that the White House has maybe championed to say like, hey, we're going to save some money, in addition to all the Doge initiatives. I think the ultimate here is, right, do you go, well, we saved all this money through Doge, we're going to give it back to the people through tax cuts. I think that is ultimately where, some of this is headed. But from hey, we'll also do some things to increase taxes, the carried interest loophole and some sports breaks for, some
Yeah,
tax breaks for
stadiums.
sports
Yeah,
owners. Yeah,
yeah,
basically right now you can sort of amortize the cost of buying your team over a very short period of time, which results in massive deductions for these individuals, even though these are highly profitable businesses. Effectively, the cost of the business is allocated mostly to contracts which expire. And so that was the argument and the basis for it. But it doesn't really match reality, right? Like sports franchises don't depreciate over the time. They tend to appreciate, if anything. So that is one change. And the carried interest loopholes, the other, you said, does that really impact advisors? It does if they have clients who are in that situation,
right.
and it does for like money managers who are profiting or earn their keep that way. Effectively, what the carried interest loophole is you can earn your earned living by getting a piece of, let's say, like the gains or something as it's in there, and instead of that being taxed as ordinary income, even because you're working for that's your
Mm-hmm.
pay, it becomes a capital gain, right? That is a very lay definition of what's going on there. And the reality is, if it's your earnings, you probably, like the same way, Roger, if you decided to give somebody property instead of giving them, a wage, it doesn't matter. It's for their work, right? They would still be taxing it as ordinary income, at least on what was paid out to them. So that is something that's been proposed. But candidly, Roger, that was proposed
Yeah, I've heard about it for years.
2017.
Yeah,
It's always been proposed. Both of those groups, the sports owners and the people who benefit from carried interest, have a lot of money and give a lot of money. So I'm not
yeah,
going to say it's not going to happen. Maybe it's a very populist thing to do, and the president can tout that going forward. But he's going to have a lot of unhappy donors. Maybe he doesn't care. He's not going to run again. But maybe he does, and ultimately this is just putting it out. I would say too early to tell whether those things will occur. But for most clients and most advisors, those are not really the big things. It's why I go back to, again, whether you're happy politically or not about that, from making our lives as simple as possible and giving us the break we probably deserve as advisors after the last decade or so of constant barrage of changes in the law between Tax Cut and Jobs Act and Secure Act 2 and Paycheck Protection Program and everything else that happened. We probably have it as easy as we could as advisors. Doesn't mean it's easy. Just means it's as easy
yeah.
as it could. It's all relative.
So Jeff, if you're running a projection for your own clients right now, within
Yep.
Holistiplan, by the way, in our own scenario analysis screen, you have a toggle that says in
Yep.
2026, the tax laws sunset or they don't. And I know we're talking probabilities here, but
Yeah, 100%. There is zero chance, Roger, unless a client tells me,
okay,
run the scenario assuming
yeah.
Congress doesn't
Otherwise, you're running
there's
it assuming no sunset. Yeah,
100%. Yeah.
yeah,
Yeah. I think at this point it is. I understand somebody could say, well, it's more conservative because most people will have higher taxes if things go away.
yeah.
But at some point, you got to look at reality and say that is just, it is possible, but it is highly,
Right.
highly, highly unlikely. What I would say is, as advisors, we typically have our baseline scenario and then our kind of what ifs, right? Whatever you want to call that in your world, right? It's like, well, here's what happens if my client lives to 95, but what if they die at 60? Like, what does that look like? Or what if they get into a long-term care event? What if the baseline scenario should be the Tax Cut and Jobs Act provisions are extended, and the what if is something weird happens and it's not.
Yeah. Yeah. Okay, that makes sense. Okay, final question. So how would you advise an advisor who wants to keep up with this stuff to, what should they be watching for? What are the news sources or the think tanks that you would recommend? Obviously, subscribe to everything Jeff's saying out there, and we're going to do our best to try to make sure we're on the pulse of it. But if you're an advisor who wants to be on top of things, if you want to point your clients to something so you look
Yep.
informed, what sources do you recommend people look at and monitor?
Well, I think the first thing I would do is I would tell everybody like just chill. Like it's good to follow what's going
Yeah,
on, but especially in the run up to these types of pieces of legislation, there's a lot of trial balloons that are put out there. There's a lot
good
of
point.
ideas that like, oh, here's like people may recall that up until very close to the Tax Cut and Jobs Act, one of the ways they were going to try and pay for more of that bill or stuff more tax cuts in was by raising more revenue via Rothification for everyone. We have that new provision next year where high income individuals who are making catch-up contributions can only make them to Roths. That is like the first foray into what Republicans, by the way, were trying to do back in 2017, not the other way around. Republicans were trying to say high income individuals only Roth. And it was very politically unpopular. So at the end, the president said, nope, we're not touching your retirement accounts. We're going to leave them as is. But people went nuts about this. Like, oh my God, what is... And at the end of the day, it didn't happen. So I'd say to everyone first, like, chill. Let's see where things go. Let's see draft legislation first. Like this is going to be a process. It's going to go through committee. It's going to get marked up. Like things are going to happen. Don't rush to judgment about what you hear in the news. Now, having said that, it's good to be aware because clients have questions about that sort of stuff. And so where do you go? Well, the very first thing is I'd say, Roger, I'm lucky, right? I used to both meet with clients on a day in and day out basis and also try to keep up with this. I don't do that anymore, and I don't know that I could have done that for much longer because at some point you have to sleep, right? I mean, there's only so many hours in the day. So I don't expect most advisors to go through the legislation in the same way. Like one thing you could do, you can go to the source, right? Like go read the proposed regulation, read the proposed legislation. Candidly, I don't think most advisors should do that, right? Like maybe I'm a little bit biased because that's kind of my job, but the whole point is like you don't need to, you should be spending your time where it is best effective. And when we look at revenue for an advisory firm, the number one predictor of revenue that an advisor can bring in is how much time are you spending with your clients, right? It's not, how much time have you spent in the weeds and it's how much time are you spending with clients? Now, obviously, when you're with clients, you got to be productive and know what you're doing. But that's where you go to your trusted sources. And again, perhaps a little bit self-promotional, but come to a Holistiplan webinar on the topic. If there's a new tax law, Roger, I'll be, tweeting about it the days that it happened, the night that it happens. There'll be a webinar and I'll have an obnoxiously long article on kitsis.com the next day, saying here's a breakdown of everything. Find who those people are for you. Doesn't have to be me. There's lots of wonderful, whether it be Bloomberg or whatever resources you want to go to, you kind of have your people or your groups, your organizations for X, you leverage those things, right? And then repetition, because anytime there's a lot of changes, it's just a lot. Like it's just a lot to take in a short amount of time. You've got to do it twice, three times. Like I don't read a tax bill once. I do it once. I go through and make my little notations and tweet storms and whatnot. And then I probably read it another 2 to 3 times in the next week or so, just to make sure that I'm really there. Again, I don't think everybody needs to go to the code, but find your source. And when it happens, the first thing you want to do is your bookmarks, right? Like, okay, there's something on this. I have a client who's in that situation. I have something on this. You can always go back and find the details, but you just want to surface those bigger planning issues first, right? Like who is affected, how are they affected, and then you can go back and figure out exactly what to do afterwards, but just starting your action plan of how do I begin to digest such a significant change? Because even if everything stays the same, it's still news for clients and they still are going to want to know about that.
Yeah. Yeah, what's funny is like what you were saying should resonate with advisors because it's the advice we give to clients about investments. You know, like you can get all worked up about what the Italian National Bank did with such and such and such, or you can just remember we're in this for the long run, blah, 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 blah. And like the same can be true for taxes. Like there's a lot of things you cannot impact. And there's a lot of things that we're just gonna have to wait and see. We have a good idea of where the probabilities are, which is the same as the way how we look at investments. Like the most probable outcome over the long run is this. And you've laid out for us the probable outcome on tax, which is it's likely to look a lot like how it does now. And then other than that, I guess watch this space. I'll just say personally, when things start getting active, and again, my perspective is a little different because I'm trying to make sure I'm on top of things right when they change for a different reason than advisors. I'll start to monitor some of like the very political, not partisan, but the political kind of the hill.com. Like these guys are like wonky about what's going on in DC type stuff. And then I'll kind of spread out to some of the like tax foundation, all these sorts of things that are commenting on, not because I want their opinions, but because sometimes they'll draw out something that I didn't see in the article, because everyone's got their own opinion of what's important and not. And so our job, again, I agree. Like, I don't think the advisor, unless they really care, don't need to go to this level. It's kind of our job to distill this down, but it's out there. That's kind of just my personal process if people really want to get into this stuff. So
yeah, and I'll just emphasize, one thing you just said, because I think it really spoke to me. I sometimes say, if you want to have success as as an individual in life from finance perspective, you got to turn yourself into the casino. And what I mean by that is, effectively casinos make money very predictably by having the odds in their favor. There are, and long enough, right? Like there are lots of times when someone will come in and win big. There are plenty of nights where a casino will actually lose money. But over time, casinos, because the odds are in their favor, tend to make a lot of money, right? Like it's very hard to lose money as a casino operation, at least just from the gambling side of things. So from a client side, right, it's like, well, if I do this with my investments, I've got a high probability of success. If I do this with my taxes, I've got a high like you do things that put the odds in your favor enough times and turn yourself into the house, into the casino, right? Make the odds in your favor, good decisions over a long enough period of time. If you make them, there's a really, really good chance things will work out. Can't say exactly how, can't say exactly how much, but doing things that are in your favor long enough, keep the odds on your side, and you'll probably do well over time.
sounds good. Although I need to tell you about my slot machine system I have. That's for another webinar we'll do.
I worked with Ed for a long time. A slot machine means something very different to me. So
got it. There you go. All right, Jeff, awesome. Appreciate it. Watch this space because I'm sure we'll be back to kind of talk about stuff as it kind of firms up. So,
oh yeah,
Laura,
I can't wait. It's going to be an exciting year.
I hope not. I hope not too exciting. But Laura's giving us the hook. Laura, we'll turn it back over to you. Thanks, Jeff.
Thank you guys both
everyone.
so much. That was awesome.